Zimbabwe has just introduced a new currency, the Zimbabwe gold, as a way out of its economic crisis. This is according to a statement issued by the Central Bank of Zimbabwe on April 5, 2024. The new currency will be backed by a basket of currencies and precious metals, mainly gold, held by the central bank. Zimbabwe's central bank governor, Dr. John Mushaya Vanhu, said the institution had $100 million in foreign currency and 2,522 kilograms of gold, worth $185 million, 3 times the amount of local currency currently in circulation. The population has up to 21 days to exchange their old notes, and businesses will be obliged to use them to pay at least 50% of their taxes. This is a historic decision for the Southern African country, which has been plagued by high inflationary pressures in recent years. Zimbabwe has been facing a severe economic crisis since early 2000s, caused in particular by a land reform introduced by former President Robert Mugabe. This reform led to the collapse of a crucial sector of the country's economy, deterred foreign investors, and disrupted the repayment of a substantial debt to financial partners estimated at nearly $13 billion. The immediate consequence of this crisis was hyperinflation, which led the government of the day to print money, exacerbating the problem, and then in 2009 to abandon the local currency, the Zimbabwean dollar, in favor of the US dollar. In 2019, the government took the controversial decision to reintroduce the Zimbabwean dollar in the hope of stimulating the stagnant economy, but to no avail. It is worth remembering that the Zimbabwean dollar suffers from a lack of confidence among the local population, who prefer the US dollar, and its value has plummeted since last year. In April 2023, $1 US was worth about 936 Zimbabwean dollars. By April 2024, the rate had risen to almost 32,000 Zimbabwean dollars to the US dollar. And as such, this measure comes after several attempts by the Zimbabwean authorities to get the economy back on track and achieve monetary independence.